if you are used to analyzing regular companies, you generally have um, a very specific, comfortable playbook. You look at the balance sheets, you comb through the profit and loss statements.
Right. It feels very structured.
Exactly. You listen to the CEO's quarterly earnings call, and you're essentially just judging a group of humans running a corporate machine.
Yeah, I mean, it is a comfortable playbook because human-made organizations operate within a relatively controlled environment.
Yeah.
You're really just evaluating a management team's ability to execute a plan, their capital allocation, their marketing strategy. It's all contained.
Right. But today, for this custom-tailored deep dive, you basically have to take that entire corporate playbook and throw it right out the window.
Pretty much, yeah.
Because our mission today is to unpack the fascinating world of Chapter 11 from the NISM Research Analyst Workbook, which focuses entirely on the fundamental analysis of commodities.
Which is a whole different beast.
It really is. We are looking at the raw, physical building blocks of the global economy. Things you can touch, things you can burn, things you can eat.
Yeah.
Crude oil, gold, copper, wheat, lithium.
And the sheer scale of the variables here is what makes this field so uniquely challenging because there are no CEOs of copper.
Right.
There's no corporate board of directors that controls the rain in South America. To analyze these raw materials, you have to look at the world through a completely different, highly physical lens.
Exactly. And honestly, by the end of this deep dive, you will be looking at the markets like you're part meteorologist, part geopolitical analyst, and part currency expert.
Which is exactly the strange combination of skills it takes.
Yeah, it's exactly what it takes to understand how physical materials are priced across the globe. So to get started, we have to understand the absolute baseline forces governing commodities.
Right.
It isn't about profit margins or like software subscriptions. It comes down to the raw engine of the world. Physical supply and demand.
And those forces are fundamentally tied to massive macroeconomic currents. I mean, let's look at demand first.
Okay.
When you analyze a tech company, demand is based on how many people download an app. But when you analyze commodities, demand is based on global GDP growth.
Oh, wow.
Yeah, when the world economy is expanding, entire nations are ramping up industrial production. They're building bridges, skyscrapers, electrical grids.
Consumers are buying more physical goods.
Exactly. And that creates this immediate, insatiable hunger for energy, for base metals, and for agricultural products to feed a growing workforce.
But it's not just broad, generalized growth, right? It's also driven by these massive shifts in human behavior and technological pivots.
Oh, absolutely.
Like, take the shift toward electric vehicles.
Yeah.
That isn't just a trend. It is a fundamental rewiring of global infrastructure. You're basically replacing a combustion engine, which is mostly iron and aluminum, with a massive battery.
Right.
And suddenly, that single technological pivot drives the demand for specific metals like lithium, cobalt, and silver to just unprecedented levels.
Yeah, precisely. I mean, entire supply chains have to pivot instantly to feed that new demand. Another great example is shifting dietary habits.
Okay, how so?
Well, as massive populations move toward plant-based diets, or conversely, as developing nations become wealthier and start consuming more meat, the demand dynamics for agricultural commodities shift drastically.
Oh, that makes sense.
Yeah, if a country starts eating more beef, you don't just need more cows. You need millions additional tons of grain and soybeans just to feed those cattle.
Wow. Okay, so that is the demand side, shifting human behavior and industrial growth. But the supply side is where things get truly wild.
It really is.
Because supply is dictated by Mother Nature and hard physical limitations. You can't just, write a new line of code to generate more copper.
No, you definitely cannot. It is the ultimate physical constraint. You have to physically extract thousands of tons of material from the earth, process it, and move it across oceans. And that introduces major geographic bottlenecks. I mean, specific countries control massive portions of specific commodities. Consider copper, for instance. A huge percentage of the world's copper comes from Chile.
So if you are analyzing copper, you suddenly care deeply about local Chilean politics and weather patterns.
You have to. If there's an extreme weather aberration in the Andes Mountains, or, say, a local labor strike at a major mining operation like Escondida, it can instantly choke off a massive percentage of the global supply.
Why?
The entire global market, including manufacturers thousands of miles away, is entirely dependent on the local conditions of that specific concentrated geography.
You really do become a planetary detective. I
Yeah.
mean, instead of checking a company's cash flow, you're tracking El Nino weather patterns to see if they'll cause a drought in Argentina,
Exactly.
and checking the rainfall in Brazil to figure out what the global coffee harvest will look like,
Yeah.
or monitoring strikes at shipping ports just to see if the material can even get on a boat.
And because these resources are scattered so unevenly across the planet, oil concentrated in the Middle East, gold in Australia and Russia, copper in South America, they absolutely have to be traded globally. No country has everything it needs.
Which brings us to a massive logistical problem. If you have a physical supply chain that stretches from a mine in Chile onto a ship owned by a Greek company to a manufacturer in India, how do you actually agree on a price?
It's
Now
complicated.
you have a dozen different countries involved using a dozen different currencies.
You really need a universal language to avoid utter chaos. And in the global commodities market, that universal language is the US dollar. The vast majority of major commodities across the world are priced and traded internationally in US dollars.
But knowing the dollar is the default currency doesn't actually explain the mechanics of the pricing. I mean, how does that currency fluctuation translate into the final number a buyer pays?
Well, it creates a critical inverse relationship that forms the absolute backbone of fundamental commodity analysis. When the US dollar strengthens against other global currencies, commodities typically become more expensive for any buyer who is using a non-dollar currency.
Let's walk through exactly how that cascade happens. Like, give me a concrete scenario.
Sure. Let's say you're a manufacturer in Europe and your local currency is the euro. You need to buy a barrel of crude oil, which is priced at, say, $80.
Right, $80.
If the US dollar suddenly gets stronger, meaning its value increases relative to the euro, that exact same $80 barrel of oil now costs you more euros than it did yesterday. The physical oil didn't change, the $80 price tag didn't change, but your purchasing power decreased.
So because it now costs you more of your local currency, it hurts your profit margins. So you might decide to, buy less oil.
Exactly. And when buyers all over the world, in Europe, in Japan, in India, when they start buying less because their local currencies are weak against the dollar, global demand drops.
And that drops the price.
Yes. That drop in demand puts downward pressure on the commodities price. Conversely, a weak US dollar makes commodities cheaper for the rest of the world to buy. It acts like a global discount coupon, driving demand up and pushing commodity prices higher.
And traders aren't just looking at the dollar against one random currency, right? They are tracking this macro trend using the dollar index.
Right. The dollar index is basically a barometer. It measures the strength of the US dollar against a specific basket of 6 major currencies.
Which ones?
It's the euro, the Japanese yen, the pound sterling, the Canadian dollar, the Swedish krona, and the Swiss franc. These represent major global trading partners. By watching that index, commodity traders can anticipate broad shifts in global purchasing power and subsequent pricing trends.
Wait, that doesn't make total sense to me. Let's say I am a local business owner in India. I'm buying copper from a local Indian supplier to make wiring for local Indian customers. Everything is happening domestically. Why do I care what the US dollar is doing against the Swedish krona or the Canadian dollar? How does that distant currency math actually hit my local wallet?
That is a very common point of confusion. But the reality is that your local market just does not exist in a vacuum. Organized commodity exchanges act as global trade hubs, and they dictate the benchmark prices for the entire world.
Okay, so the benchmarks set the tone.
Exactly. For instance, the Chicago Board of Trade, or CBOT, sets the global tone for agricultural goods. COMEX is the benchmark for bullion, like gold and silver.
Right.
And NYMEX sets the standard for energy products. And the London Metal Exchange, the LME, is the absolute authority for base metals.
But why are those specific hubs the absolute authority? Like, why does a guy in India have to care what the London Metal Exchange says copper is worth today?
2 words: historical liquidity. Those global exchanges are where the absolute massive volumes of buying and selling happen. They have standardized contracts and guaranteed clearinghouses.
Oh, I see.
Because the majority of the world's major players trade there, they establish the true, undeniable global price. And here is how it hits your local wallet: arbitrage.
The mechanism that keeps the prices glued together.
Exactly. If the domestic price of copper in India was suddenly, say, much cheaper than the global benchmark price in London, traders would instantly buy up all the cheap copper in India and sell it in London for a guaranteed profit.
Ah, of course.
That massive buying in India would drive the local price right back up until it perfectly matched the global price, factoring in shipping and the US dollar exchange rate.
So the domestic markets are essentially forced to strictly echo those global hubs. You literally cannot escape the global pricing mechanism. If the US dollar is strong, driving the global benchmark down, your local Indian supplier is going to adjust his prices accordingly instantly.
Precisely. You really can't hide from it.
Right.
Now, we know how the currency mechanism prices the physical goods, but there's another layer. How do traders know how much physical stuff actually exists in the world before it hits the market?
Yeah, that's a good question.
Unlike a modern factory where you have software tracking every single widget coming off the assembly line in real time, you cannot easily count every ear of corn growing in a field.
Which means traders have to rely on highly specialized data trails.
Yes, exactly.
They're obsessively tracking strict data releases from government agencies. For agricultural commodities, you have crop reports and weather reports.
And those reports are incredibly detailed. I mean, they track planting progress, literally what percentage of a nation's seeds are in the ground by a certain date.
Wow.
They issue yield estimates based on soil moisture and satellite imagery. A tiny percentage change in an acreage estimate from the U.S. Department of Agriculture can shift billions of dollars in the futures market in seconds.
But the ultimate, undisputed source of truth across almost all commodities is inventory data. Inventory is the actual quantity of a commodity sitting in a warehouse, a storage tank, or a government reserve. I actually always think of inventory data like checking your global pantry before a massive snowstorm hits.
That is a really great way to visualize it.
Yeah, if you hear a storm is coming, the first thing you do is open your fridge. If the fridge is completely full, like if you have high inventory, you're calm. You know you have enough food to ride it out.
Right.
You certainly aren't going to run to the store and pay premium prices for a gallon of milk. High inventory removes the fear.
And in the markets, that high inventory signals an oversupply or, a comfortable buffer, which naturally puts downward pressure on prices. Buyers aren't desperate, so sellers have to compete on price.
But if you open that fridge and it is totally empty, and the weather report says the roads will be blocked for a week.
Panic sets in.
Yeah, absolute panic. You run to the store, and you are willing to pay almost anything for a simple loaf of bread because of the scarcity. Low inventory triggers scarcity, and scarcity triggers massive price spikes.
And this is where the human element completely overrides the natural forces of supply and demand. What happens to your pantry analogy if your fridge is empty, but then the local government suddenly announces a ban on all grocery deliveries?
Oh, man. Then it is absolute chaos. The price of whatever food is left goes astronomical. And that happens constantly in commodities, right? Governments and central banks are deeply involved in these markets.
They are massive players. Let's look at macroeconomic indicators first. Inflation is a perfect example. When inflation rises rapidly, the purchasing power of fiat currency, paper money, decreases.
Right. A dollar buys less than it did yesterday.
Exactly. In response, investors typically rush toward precious metals like gold.
Because gold is historically viewed as a safe haven asset. It cannot be printed by a central bank. Its physical scarcity protects purchasing power.
Spot on. Central bank interest rates also dictate massive commodity movements. When central banks lower interest rates, borrowing money becomes cheap. That encourages companies to take out loans and build new factories, which massively lifts the demand for industrial commodities.
Makes sense.
But when they raise rates to cool the economy, borrowing gets expensive, industrial expansion slows down, and commodity demand drops.
And then you have direct, aggressive human intervention through geopolitics.
Yeah.
Human policies literally manipulate the markets. We see trade policies like sudden export bans.
Right, those are huge.
If a country suffers a terrible wheat harvest, the government might panic about feeding its own citizens. So they ban all exports of wheat. They trap the supply inside their own borders to keep local prices down.
But by doing that, they instantly remove millions of tons of wheat from the global market, causing global prices to surge overnight. You also have government subsidies, where a government artificially pays farmers to grow certain crops, lowering their production costs and skewing the natural supply.
And obviously, you cannot discuss geopolitical market manipulation without talking about crude oil and OPEC.
Oh, absolutely. The Organization of the Petroleum Exporting Countries. OPEC is basically a cartel of major oil-producing nations. They routinely hold meetings, look at the global price of oil, and strategically agree to increase or decrease their physical output.
Wow.
They literally choke or open the valve on millions of barrels a day specifically to manipulate the global price benchmark.
Add in the fact that many of these major producing regions, particularly in the Middle East, are historically volatile. A sudden conflict can cause immediate, severe supply disruptions.
It's a lot to keep track of.
It really is. So let's zoom out and look at the picture we've painted here. You have weather disasters, sudden currency swings, government export bans, unpredictable inflation, and geopolitical conflicts. It is an environment of total, absolute chaos.
It is arguably the most volatile sector in global finance.
Which raises a huge question. If you are a physical business that relies on these materials to survive, say you are a commercial bakery buying thousands of tons of wheat, or an airline buying millions of gallons of jet fuel,
Okay.
how do you not go bankrupt overnight? If a war breaks out and jet fuel triples in price in 24 hours, how does an airline survive that volatility?
They survive because they utilize a very specific mathematical financial shield. It is called hedging. And we need to establish the golden rule of hedging right away. The purpose of hedging is not to make a profit.
I'd say that again because I think people always confuse hedging with speculation.
They do. It is strictly a risk management tool. Its entire purpose is to stabilize earnings and cash flows by protecting the business from adverse price fluctuations. You use the derivatives market, like futures and options contracts, to offset the potential losses in the physical market of your everyday business.
Okay, let's break down exactly how this shield works with a classic example. Imagine a farmer planting wheat in the spring. He is pouring money into seeds, fertilizer, and tractor fuel. But he has no idea what the price of wheat will be in the fall when he finally harvests and sells it.
Right, he is entirely exposed to the market. If bumper crops around the world cause the price of wheat to crash by harvest time, the price he gets won't even cover his costs. He literally loses his family farm.
So he turns to the futures market. Today, while he is planting, he sells wheat futures contracts that match his expected harvest volume. He basically locks in today's price for delivery in the fall.
And here's the mechanics of the offset. Let's say harvest time arrives and the physical price of wheat has indeed crashed. He takes a massive loss selling his physical wheat at the local grain elevator.
Right.
However, because the overall market price dropped, the short futures contracts he sold months ago are now highly profitable. The money he makes on the paper futures contract perfectly offsets the money he lost on the physical wheat. His revenue is stabilized.
It's brilliant. And it works on the consumer side, too. Think of that airline company we mentioned. Their absolute biggest variable cost is jet fuel, which is directly tied to crude oil. A sudden geopolitical shock that spikes oil prices could wipe out their entire operating profit for the year.
Exactly. So the airline does the reverse of the farmer. They buy crude oil futures contracts today.
Right.
They lock in their fuel costs in advance for the next year.
Right.
If a war breaks out and physical fuel prices skyrocket, the airline has to pay that higher physical price at the pump. But their futures contracts skyrocket in value as well, perfectly covering the difference.
Hang on, though. I understand the math, but this always bothers me from a business strategy perspective. If hedging perfectly locks in your price, it absolutely caps your potential gains, too.
Yes, it is a symmetrical shield.
Right. So if I am that airline CFO and I lock in my oil futures at $80 a barrel just to be safe, and then a sudden glut in supply causes global oil prices to plummet to $40 a barrel, I am stuck paying the equivalent of $80 a barrel because of my contracts.
You are.
Meanwhile, a startup competitor who didn't hedge is buying dirt-cheap fuel and slashing their ticket prices. Doesn't that make me look foolish? Is that peace of mind really worth permanently capping your upside?
That is a brilliant question, and it really gets to the core psychology of corporate finance versus trading. You are looking at it through the lens of a trader trying to maximize a return on investment. But for the chief financial officer of an airline, predictability and survival always trump the gamble for extra profit.
Because the downside risk is fatal.
Exactly. If the airline doesn't hedge, hoping for cheap oil, and instead prices spike to $150 a barrel, they don't just have a bad quarter, they go bankrupt. They cease to exist.
Wow.
The CFO doesn't care about the regret of missing out on a cheap oil windfall. They care about ensuring the business survives to fly another day. Hedging removes the existential threat from the equation. It allows the airline to focus on selling tickets, not gambling on global geopolitics.
Wow. Okay, survival over profit. That makes total sense when the stakes are that high.
Yeah.
But I imagine they don't just blindly guess how many futures contracts to buy. If it's a shield, you need to know exactly how thick to make it.
Oh, it is an incredibly exact science. Analysts use something called the hedge ratio to calculate exactly how much of their physical position needs to be covered by derivative instruments to optimally minimize risk.
Okay, let's translate this into some audio math. I know the actual formula involves coefficients of correlation and standard deviations, but conceptually, What is the hedge ratio actually measuring?
It is measuring two things: correlation and volatility. First, correlation. It asks, how closely do the price of the physical commodity, the spot price, and the price of the paper futures contract actually move together?
Because they don't always match perfectly.
Right. Sometimes local physical prices disconnect slightly from global paper prices. If they don't move in perfect synchronized lockstep, you have to adjust the size of your hedge to compensate.
Got it. And the second part is comparing the volatility. You are essentially looking at how wild the swings in the physical market are compared to the swings in the paper market.
Exactly. If the physical market you are operating in historically swings twice as violently as the futures market, the math tells you that you need to buy more futures contracts to build a thick enough shield.
Wow.
You factor in the correlation, you divide the volatility of the physical price by the volatility of the paper price, and it spits out a precise ratio. You apply that ratio to your inventory, and you know exactly how many contracts to execute.
It's incredible. It is taking the absolutely unpredictable, chaotic forces of Mother Nature, human psychology, and geopolitics, and mathematically translating them into a precise defense mechanism.
It really is fascinating.
So, take a breath and look at the journey you've just taken with us today. We threw out the standard corporate balance sheets. We learned that the fundamental analysis of commodities is this wild, interwoven global ecosystem.
Absolutely.
You're tracking El Nino to predict supply. You're monitoring the strength of the U.S. dollar to predict global purchasing power. You're watching local markets echo global hubs like the LME.
Right.
You're reading the geopolitical tea leaves of export bans and OPEC meetings. And finally, you are using exact mathematical hedging to ensure human businesses survive the inevitable volatility.
Because every physical limitation, every drop of rain, and every political decision ripples across the globe and eventually settles into a single global price. It really is the raw engine of the world.
It is. But before we sign off, we want to leave you with a new, mind-expanding question to ponder on your own.
Oh, I like this.
Everything we talked about today, from the dollar index to tracking crop reports to the hedge ratio, is fundamentally driven by physical scarcity. The cost of extraction, the hard limits of supply, the fact that there's only so much copper in the Andes Mountains.
Right, scarcity is the foundation.
But what happened to this entire global structure of commodity analysis if a highly anticipated technology actually arrives? What if commercial nuclear fusion suddenly provides a virtually limitless, incredibly cheap supply of energy?
Oh, wow.
Or what if lab-grown agricultural synthesis allows us to produce limitless wheat and meat without weather constraints? How do global markets even begin to price a commodity or hedge the risk of a commodity when the scarcity part of the equation drops to near zero?
That is a profound scenario. I mean, if the physical limitations are removed by technology, the very foundation of how we value the building blocks of human civilization changes entirely. The old rules will simply cease to apply.
It's definitely something to chew on while you look at the weather report tomorrow. Thank you for joining us on this deep dive into the fundamental analysis of commodities. Keep questioning the systems around you, keep looking for those hidden connections, and we'll see you next time.